the buy, borrow, die strategy, the holy trinity of tax avoidance. Picture this, you're playing Monopoly, but instead of paying taxes when you land on certain squares, you've found a way to never pay taxes while still using all your money to live like a king. That's essentially the buy, borrow, die strategy, the most elegant tax avoidance scheme ever invented, and it's completely legal. Wealthy households can use the three-step buy, borrow, die strategy to get massive capital gains tax advantages. This strategy is so perfectly designed that it protects the inheritance of wealth, especially extreme wealth, allowing the very wealthiest families to hold, live off of, and transfer that wealth without ever paying taxes on it. And it's all legal. Here's how this financial magic trick works. First, you buy stocks, bonds, real estate, art, or other high-value assets. You strategically hold on to these assets and allow them to grow in value. The beautiful part is that you won't owe income tax on the growth in the asset's value unless you sell them and make a profit. Then comes the genius part. Instead of selling your assets to get cash, which would trigger taxes, you borrow against their growing value and use the newly available cash to live off or invest in other assets. The family does not owe taxes on its asset-leveraged loans because the government doesn't tax borrowed money. You're basically living luxuriously while continuing to grow your wealth, untaxed, indefinitely. The final step is where it gets truly diabolical in its brilliance. You keep the original appreciated assets until death, leaving those assets to an heir. When you die, the tax code performs what can only be described as reliable financial amnesia. It steps up the baseline value of the assets from the original price to their value at the time of death, completely wiping out any tax liability for the capital gains. Loopholes in the US tax code allow some billionaires to pay taxes equal to only 1% of the increases in their wealth. It's like playing a video game where you've discovered a cheat code that makes you invincible while everyone else is still playing by the normal rules. The carried interest loophole, Wall Street's favorite tax break. If the buy, borrow, die strategy is the holy trinity of tax avoidance, then carried interest is Wall Street's favorite child that gets away with everything. The Hill referred to it as Wall Street's favorite tax break. This loophole is so audacious that it basically allows some of the richest people in America to pay lower tax rates than nurses and teachers. The treatment of carried interest continues to be one of the most controversial elements of the US tax code. Here's the setup. Private equity, hedge fund, and venture capital managers typically get paid in two ways: a management fee, usually 2% of the money they're managing, and carried interest, usually 20% of any profits they make. The management fee is taxed as ordinary income at rates up to 37%, which is what you'd expect for someone earning millions of dollars. But here's where the magic happens. Carried interest on assets held for more than 3 years is often treated as long-term capital gains, with a top rate of 20%. The carried interest tax loophole is tax alchemy that magically turns ordinary compensation income into preferentially taxed investment income. It's like convincing the IRS that your salary is actually a lottery winning, so you should pay less taxes on it. The term carried interest can be traced back to the 16th century when transoceanic ship captains would frequently take a 20% interest of whatever profits were realized from the cargo they carried. So we're using a 500-year-old concept designed for literal pirates to justify why modern financial pirates should pay less in taxes. The carried interest loophole allows investment managers to often pay almost half the tax rate compared to most other Southwest Washington workers. Think about that for a second. Someone managing a billion-dollar fund pays a lower percentage in taxes than someone managing a classroom of children. Offshore tax havens, where money goes to disappear. If carried interest is Wall Street's favorite tax break, then offshore tax havens are where money goes to play hide-and-seek with the IRS. About $4 trillion in US wealth is stashed overseas, much of it in tax havens. That's not a typo, $4 trillion with a T. Globally, individuals hold about $7 trillion, corresponding to roughly 10% of world GDP, in tax havens. To put that in perspective, that's more money than most countries' entire economies. It's like discovering that 1 out of every $10 in the world is playing an elaborate game of international hide-and-seek. The basic concept is beautifully simple. Wealthy U.S. investors can avoid U.S. tax by setting up corporations or trusts in tax havens, where local tax rates are low and U.S. tax on investment income generally is not withheld. It's like opening a bank account in a parallel universe where taxes don't exist. Hong Kong tops the list with over $2.8 trillion in offshore wealth. These aren't vacation funds we're talking about. This is serious money that's been moved specifically to avoid taxes. Ownership of offshore assets was highly concentrated among a small number of very wealthy households. About 1 in 5 of those in the highest income 1% held assets overseas, increasing to more than 60% for households in the top 0.01%. The most popular destinations read like a travel brochure for tiny tropical islands and European banking centers. The Tax Justice Network's Corporate Tax Haven Index ranks the top 3 as the British Virgin Islands, Bermuda, and the Cayman Islands, all British overseas territories. These places have more registered companies than they have people, which should tell you something about what's really going on. Tax havens collectively cost governments between $500 billion and $600 billion a year in lost corporate tax revenue, and that's just corporate money. When you add individual tax avoidance, we're talking about enough lost revenue to fund entire government departments. Private placement life insurance, the rich person's savings account. If you've never heard of private placement life insurance, PPLI, congratulations, you're probably not rich enough to need it. This is one of those loopholes that's so complex and expensive to set up that it's exclusively for people who have more money than small countries. The uber wealthy have another trick, which is to buy into very pricey private placement insurance policies, which earn interest. You can not only invest the insurance policy money in high-growth options like hedge funds, you can borrow money from this asset, and if you cancel the policy and get all your money back, you won't be taxed. Think of PPLI as a Swiss Army knife for tax avoidance. It's technically an insurance policy, which means the investment growth inside it isn't taxed. But unlike regular life insurance that you might buy to protect your family, PPLI is designed specifically to hold investments, often the same hedge funds and private equity investments that would normally be heavily taxed. The beautiful part, if you're wealthy, is that you can borrow against the policy's value, giving you access to your money without technically withdrawing it and triggering taxes. It's like having a magic savings account where you can spend the money without the government knowing you spent it. The catch? These policies typically require minimum investments of $5 million or more, and the fees can be substantial. But when you're talking about avoiding taxes on hundreds of millions of dollars in investment gains, even expensive fees look like a bargain. Tax loss harvesting, losing money to make money. Can you imagine being so wealthy that it's to your advantage to lose money? Welcome to tax loss harvesting, where billionaires have figured out how to turn losing money into a tax strategy that would make a magician jealous. Here's how this financial sleight of hand works. Typically, what the wealthy do is sell investments when they are low, then make other similarly valued investments, essentially balancing out any gains made with the losses taken. Not only does this keep your money invested, it reduces your tax liability. It's like having a really sophisticated accountant who can convince the IRS that your wins don't count because you also had some losses, even though you strategically timed both the wins and the losses to maximize your tax benefits. You're essentially playing financial chess while everyone else is playing checkers. The wealthy have turned this into an art form. They'll sell losing investments right before the end of the tax year to realize the losses for tax purposes, then immediately buy similar, but not identical, investments to maintain their market exposure. It's like selling your Honda and buying a Toyota, so you can tell the government you lost money on cars while still having a car to drive. Business loss, carry forwards, the time machine of tax deductions. Wealthy people often start numerous business ventures, yet not every business turns a profit immediately. When that happens, it's considered a net loss. The IRS allows for business owners to carry forward an operating loss to a year when it might make more tax sense for the business by lowering that year's taxable income. This is basically a time machine for tax deductions. Lose money in 2023? No problem. You can use that loss to reduce your taxes in 2024, 2025, or even further into the future. It's like being able to use yesterday's bad luck to improve tomorrow's tax bill. The genius is in the timing and scale. While a small business owner might carry forward a few $1,000s in losses, billionaires can carry forward losses in the hundreds of millions. Donald Trump famously used this strategy to avoid paying federal income taxes for years by carrying forward massive losses from his casino businesses. It's perfectly legal, but it creates a situation where someone can lose nearly $1 billion in bad business decisions and then use those losses as a shield against paying taxes on future income for decades. It's like getting a permanent get-out-of-taxes-free card because you were really bad at business one time. The step-up in basis loophole. Death as a tax strategy. One of the most mind-bending aspects of the tax code is how death can be the ultimate tax strategy. Neither the current federal or local tax code require the original asset holders or the heir to pay taxes on the growth in value up to that point. Instead, the tax code wipes out any tax liability for the capital gains by stepping up the baseline value of the assets from the original price to their value at the time of the benefactor's death. Let's say your grandfather bought $1 million worth of stock in 1980, and by the time he dies in 2025, that stock is worth $50 million. Under normal circumstances, someone would owe capital gains taxes on that $49 million increase. But because of the step-up in basis, when you inherit the stock, the government pretends your grandfather bought it for $50 million the day before he died. This enables the wealthy family's heirs to altogether avoid taxes on the increased value of stocks, real estate, and valuable artwork. The $49 million in gains just disappears as far as the tax code is concerned. It's like the government developed sudden amnesia about the past 45 years of investment gains. This creates a perverse incentive where the wealthy are literally better off financially by dying rather than selling their assets while alive. It's the only situation where death is genuinely a sound tax strategy, which should probably tell us something about how broken this part of the tax code really is. Estate tax avoidance, generational wealth protection. The estate tax is supposed to be the government's way of preventing the creation of permanent aristocracies by taxing large inheritances. But like most tax laws, it's been turned into a playground for creative accountants and lawyers. The TCJA had roughly doubled the estate tax exemption, but it was scheduled to revert back after 2025. Now, the OBBBA made the higher exemption permanent. Starting next year, the exemption rises to $15 million per individual, $30 million for married couples. What this means in practice is that you can leave $15 million to your kids tax-free, or $30 million if you're married. But here's the thing, that's just the basic exemption. Wealthy families use trusts, charitable remainder trusts, family limited partnerships, and other vehicles to effectively multiply this exemption many times over. Wealthy families have essentially turned estate planning into a competitive sport where the goal is to transfer as much wealth as possible to the next generation while paying as little in taxes as possible. They use techniques like grantor retained annuity trusts, GARATs, charitable lead annuity trusts, CLATs, and other acronym-heavy strategies that sound like they were invented by aliens, but are actually just very sophisticated ways to move money around without triggering taxes. Corporate shell games, the art of moving profits around. Large corporations have turned tax avoidance into a global game of three-card Monte, except instead of cards, they're shuffling profits around the world to make them disappear from tax authorities. These 15 jurisdictions together accounted for just 3% of global economic output outside the US in 2020, yet American corporations reported to the IRS that 59% of their total offshore profits were generated in these tiny places. This obviously reflects accounting gimmicks used to escape taxes. The basic strategy involves setting up subsidiaries in low-tax countries and then using complex financial arrangements to make it look like most of the company's profits were earned in those countries, even though the actual business happens somewhere else entirely. A stunning $12 trillion, almost 40% of all foreign direct investment positions globally, is completely artificial. It consists of financial investment passing through empty corporate shells with no real activity. It's like setting up a lemonade stand in your backyard, but claiming that all the profits were actually earned by your subsidiary lemonade stand that exists only as a mailbox in Bermuda. The lemonade never goes to Bermuda. The customers never go to Bermuda. but somehow all the profits magically appear there where they're taxed at 0% instead of the 21% corporate rate in the United States. Companies will create elaborate structures where their US operations pay licensing fees or royalties to their offshore subsidiaries for the use of intellectual property. The subsidiary doesn't actually do anything. It just owns some patents or trademarks on paper. But by paying these fees, the company can shift profits from high-tax jurisdictions to low-tax ones. Private equity fee structures, turning salary into investment income. Private equity firms have created one of the most elegant salary-to-investment income conversion schemes in modern finance. Private equity firms drain portfolio companies through dubious fees like so-called monitoring fees, charges for vague consulting services that are really just dividends and thus taxable income under another name. But because these fees are a deductible cost, private equity firms extract wealth while shrinking the taxable income of the companies they own. Here's how this works. Private equity firms buy companies using mostly borrowed money. Then they charge these companies management fees, monitoring fees, transaction fees, and various other fees for services that range from legitimate consulting to basically just existing. One study found that private equity firms were extracting $1 billion a year in untaxed fees that should have been considered income. The genius is that these fees are tax-deductible expenses for the companies paying them, but they're often structured in ways that minimize the taxes paid by the private equity firms receiving them. It's like being your own customer and charging yourself fees, then deducting those fees while finding creative ways to avoid paying taxes on the money you paid yourself. The companies become less profitable and therefore pay less in taxes, while the private equity firms extract wealth that's often taxed at preferential rates. It's a win-win situation, as long as you ignore the workers who lose their jobs when the companies are gutted and the taxpayers who lose revenue when profitable companies suddenly become unprofitable on paper. Charitable deduction strategies, tax breaks, disguised as generosity. The charitable deduction is supposed to encourage generosity, but wealthy taxpayers have turned it into a sophisticated tax avoidance vehicle that would make Robin Hood dizzy. The proposal includes a specific loophole that would benefit billionaires and other wealthy investors. Specifically, the scheme would allow taxpayers to make contributions using marketable securities to schools in the form of unrealized capital gains. By allowing these taxpayers to ultimately claim the contribution as a tax credit on their federal returns, the proposal would allow investors to realize capital gains without having to pay taxes on them. Here's a simple version of how this works. You own stock that's worth $1 million, but you originally paid $100,000 for it. If you sell the stock, you'd owe capital gains taxes on the $900,000 profit. But if you donate the stock directly to charity, you get to deduct the full $1 million value while never paying taxes on the $900,000 gain. But wealthy donors have taken this basic strategy and turned it into an art form. They use charitable remainder trusts, donor-advised funds, private foundations, and other vehicles to maximize their tax benefits while maintaining significant control over the donated assets. Some donors even use charitable lead annuity trusts, where they donate money to charity but structure it so that they or their heirs get most of the money back after a certain period while still claiming large charitable deductions today. It's like loaning money to charity, claiming you gave it away for tax purposes, then getting it back with interest. The executive compensation shell game, $1 million deductions. While there's technically a $1 million cap on the amount of executive pay that public companies can deduct for certain top officers, many loopholes still allow excessive compensation to slip through. This means working families' taxes are subsidizing the bonuses paid to millionaire executives. Companies have gotten creative about working around the $1 million deduction limit. They use stock options, restricted stock, performance bonuses tied to metrics they can manipulate, and other forms of compensation that either aren't subject to the limit or can be structured to avoid it entirely. Private firms, including many of those owned by private equity firms, aren't even subject to these limits, meaning they can continue writing off massive CEO pay packages as ordinary business expenses. So while public companies have to play by some rules, private companies can deduct unlimited executive compensation as a business expense. The result is that taxpayers are effectively subsidizing compensation packages that can reach tens or hundreds of millions of dollars per year. It's like the government paying part of the salary for every CEO who makes more than most people could spend in several lifetimes. The REIT loophole, real estate as a tax shelter. Real estate investment trusts, REITs, were created to allow regular people to invest in large-scale real estate projects. But like most well-intentioned tax provisions, they've been repurposed by the wealthy as yet another tax avoidance vehicle. REITs don't pay corporate income taxes as long as they distribute most of their income to shareholders. This sounds fair until you realize that wealthy investors can structure their affairs so that they own REITs through tax-advantaged entities, receive the distributions in tax-deferred accounts, or use other strategies to minimize the taxes on those distributions. Wealthy real estate investors also use REITs in combination with other strategies like opportunity zones, areas where you can defer and reduce capital gains taxes by investing in distressed communities, to create complex tax avoidance structures that would require a PhD in tax law to fully understand. The International Tax Planning Smorgasbord. International tax planning for the wealthy is like a buffet where you can sample tax advantages from around the world and combine them in ways that would make international tax treaties weep. Wealthy individuals use foreign trusts, international life insurance policies, foreign partnerships, and other cross-border structures to take advantage of differences in how different countries tax various types of income. They might be a tax resident of a low-tax country while maintaining economic ties to high-tax countries, or structure their affairs so that income is earned in one country, held in trusts in a second country, and ultimately distributed to beneficiaries in a third country. The US has tried to crack down on this with laws like FATCA, Foreign Account Tax Compliance Act. But, as a result, wealthy taxpayers continue to use schemes involving offshore entities and secret bank accounts to successfully hide billions in income from the IRS. There are hundreds of thousands of shell companies in offshore tax havens that have been turned into IRS-approved banks with virtually no scrutiny by the IRS. It doesn't take a rocket scientist to see how this loophole leads to billions in tax evasion. The enforcement problem. David versus Goliath's army of lawyers. All of these loopholes exist in an environment where the wealthy have vastly more resources to fight the IRS than the IRS has to fight them. Budget cuts at the IRS have made it harder for the agency to crack down on wealthy tax cheats. Since 2010, the number of enforcement staffers at the agency has fallen by nearly a third. That means less revenue for everything from military spending to social programs, with an estimated $600 billion in owed taxes going uncollected each year, according to the Treasury Department. That's $600 billion with a B, enough money to fund significant portions of the federal government. Certainly, policymakers who decide to take up our proposal will have to keep in mind that billionaires can afford the most pricey tax lawyers to lower their tax bills. When one side of a dispute can afford teams of Harvard-educated tax lawyers, and the other side is a government agency that's been systematically defunded, it's not hard to guess who usually wins. The conclusion: the game is rigged, but it's legal. So there you have it, every major tax loophole used by billionaires, from the elegant simplicity of buy, borrow, die, to the mind-bending complexity of international trust structures that require teams of lawyers to understand. What's fascinating is that most of these strategies are completely legal. They're not criminal tax evasion. They're sophisticated tax avoidance, using loopholes that exist because our tax code was written by and for people who understand exactly how these systems work. The reality is that their effective tax rates, what they pay relative to their total wealth, are far lower than those of middle-class and working-class individuals. While regular people pay taxes on every paycheck, billionaires have found ways to live luxurious lifestyles while paying minimal taxes on their wealth. The common thread running through all these loopholes is that they're available primarily to people who already have vast amounts of wealth and can afford the expensive lawyers and accountants needed to implement them. It's like discovering that the game of Monopoly has a secret rulebook that only some players get to use. Tax havens collectively cost governments between $500 billion and $600 billion a year in lost corporate tax revenue. And that's before we even account for individual tax avoidance. We're talking about enough lost revenue to transform entire societies. Some argue that closing these loopholes would harm economic growth or drive wealthy individuals and companies overseas. Others argue that a fair tax system where everyone pays their share would generate the revenue needed to fund education, infrastructure, healthcare, and other investments that actually drive long-term economic growth. The question isn't whether these loopholes exist, they clearly do. The question is whether we as a society are comfortable with a system where your tax rate depends not on how much you make, but on how much you can afford to spend on tax planning. Whether you see these strategies as sophisticated financial planning or legalized tax evasion probably depends on which side of the wealth gap you're on. But one thing is clear: understanding how these loopholes work is the first step toward having an informed discussion about whether they should continue to exist. After all, democracy works best when everyone understands the rules of the game, especially when some players seem to be playing by a completely different set of rules than everyone else.